Hello, everyone. Welcome to this month's Fireside Chat. Just as a reminder, I am Fundera's Editor-in-Chief, Meredith Wood, and I am doing these chats every month with a member of the Fundera team or the Fundera network to kind of help diagnose some subjects that may be a little bit more complex for business owners to really help them throughout their loan application. And this month, I am joined by Michael Schwartz, who is a Senior Account Executive here at Fundera. Mike, can you say hello and tell us a little bit about yourself?
Hey, Meredith. Yes, I am Michael Schwartz. I'm a part of the customer success team here at Fundera. I joined Fundera in October of 2014 after a somewhat lengthy career at PNC Bank. I worked as a business development officer within their SBA finance group and have joined the team here to help assist with some of the more complex long-term loans that we are able to offer.
Awesome. Thank you so much for joining us today, Mike. Today we're actually going to be tackling a topic which is one of my favorites, and I think one of the my most favorite things we do here at Fundera, which is helping business owners graduate into lower cost, longer term loan products over time. And Mike, I know you do this a lot with Fundera customers. So just to kind of start out, can you explain what we mean when we say a borrower is graduating into a different loan product?
Sure. So, the easiest way to conceptualize it is when you have when you're entering, an agreement to take out a loan, there's obviously a variety of different products out there. I look at them as different levels or structures as far as what you can secure at any point in time. On our short-term products, they're a little bit easier to attain. They don't require as strong credit or as lengthy a time in business. So I kind of equate them into what you might consider elementary or middle school. And, they're something that the most basic of business owner should be able to attain. But as you grow your business and become a little bit more matured and structured, you should be eligible to secure something that is also a bit more matured and structured. And eventually, we have you graduating to a point in which you've entered college and, should be able to walk into any bank and get, the funding that you need at a reasonable rate, all things considered. So if you start back on the basic, bottom rung, let's say you don't have a significant credit history behind you. You've just opened your business. You don't have the strongest personal credit, but, that's only because the fact that, you're new to this. You're new to business credit, you're new to personal credit. So you may only be able to secure something in the short-term space. Still a good product, still something that's going to enable you to help and grow your business. But it's also something that's very easy to become accustomed to and used to. And the challenge with that is it's also a costly product. So one of the things that we like to do here at Fundera is try to come up with a full time frame and lifespan of your business and the type of loans that you may be able to secure. Let's say we start in that short-term realm. Eventually, we're going to want to move you into the midterm multi-year space, which is going to be a little bit more cost-effective. And then eventually, push you out into an SBA loan or possibly introduce you to a banking partner that can get you, a bank loan that's going to be at the absolute lowest cost of capital.
That's great. And so if I am a borrower who's in a shorter term loan, and so these are usually loans 3 months to 18 months in length, they've got daily ACH payments, potentially weekly, or even, let's say I'm in a medium term product, which we sort of see as 1 to 5 years in term length, monthly payments. What do I need to be concentrating on if I want to move up into that next category, whether that's from short term to those multi-year products or from a multi-year product into an SBA product?
It's an interesting question. Oftentimes, business owners will just look at how much. So how much money can I get you today? But the real question is, once I get you that money, how easy is it going to be for you to repay that loan amount? Mm-hmm. So when you look at the shorter term products, think about it. It's easy to think, that a one chunk of money paid back over a 1 year time at any interest rate is going to be more costly than stretching it out over 5 years. So the way that we are trying to position this is you get a short-term loan, and let's say someone gives you $10,000 and they tell you that your repayment's going to be $12,000. Well, if you have a year to pay back that $12,000, you're going to be paying back $1,000 a month. Now, let's say that same $10,000 loan gets stretched out over 2 years. Then at the same interest rate, $12,000 over 2 years, your payment's only going to be $500 a month. So that's going to be far less of a constraint on your available cash flow. So what we're looking to do is not only minimize the amount of money that you're able to secure, but the amount of money that you're spending on a month-to-month basis, because that's going to be capital that you have to operate your business. You don't want to take a loan out and then spend all of your time repaying the lender. You want to be able to utilize that money and grow your business further. So the short-term lenders give you something that you can turn around very quickly, and that's the that's the end goal. But the multi-year and longer-term lenders are going to give you a sum of money that you should be able to implement into hiring additional employees or implementing some sort of strategic change that's going to grow your business in another way that's not going to require an accelerated payback. It's going to give you a long or drawn-out period in which you can slowly pay off the loan in increments, but also utilize the funds the way you hope will help grow your business.
So how do I graduate? Like, how do I go from being somebody who's only eligible for shorter term loans into a business that can secure something longer term?
So that's where myself and my associates would step in. Our aim is to get you whatever product you're qualified for and that suits your needs. So if you need money tomorrow, we have lenders that can capture that and make it happen. But we're also going to let you know that in the big picture, we may be able to have those loans refinanced into a longer term structured product. The way it works is we'll spell out all the options that you have on the table, and we'll allow you to choose what's the best fit. Once you've got that product and you've been able to utilize it, we'll introduce you to our account management team, and they'll explain the benefits of potentially graduating you and how much time it's going to take. So certain lenders will give you the opportunity to renew or access additional credit. But the way that works is they may say they want to ensure that for 6 months' time, you're able to repay your loan in good standing. So at that 6-month anniversary, Fundera will reach out to you. And, for one, we're just looking to catch up and see how everything's doing on your end. And in the event that your loan is being repaid in good standing, the next idea would be then to say, listen, we have this lender on the platform that may be able to assist, or we've got some new lenders that are on the horizon that may be able to assist. And would you be interested in kind of moving up to the next step or graduating to the next lender, the next best option?
Mm-hmm. And what do you see are the factors that kind of affect people's graduation pace? Is it their credit score goes up? It's that they've reached a certain point of time in business, that revenue changes, they become profitable? Like, what is it that lenders are kind of using what are like the medium-term lenders looking
Sure.
at that the short-term lenders aren't?
It's really going to be all those factors, but primarily they're going to take a look at a little bit more of a deeper dive into your business's financial performance. So with the short-term products, they only require 3 months of bank statements for the most part. Business credit can be as low as 500. And when you want to move into the next level up, they're looking for a little bit more of a structured breakdown of how the business is performing. So in the short-term space, they're really looking into, do you have the funds on hand on a day-to-day basis to support this loan? It doesn't matter if the business is profitable or not. It's really on each day, would you be able to go into this applicant's business bank account and have the payment that is required be extracted from the account? If you move up to the multi-year medium-term space, those lenders are looking into the debt service coverage. And what I mean by that is, does your business off-put enough positive cash flow that you would be able to support a payment historically? So if we look back in the last 12 to 24 months, have you been performing at a high enough level where you'd be able to support the payment? Now, keep in mind, the payment is going to be reduced from what it was on the short-term space because your repayment period is going to be elongated. In addition to just the fact that there's going to be additional documents required, usually there's a higher personal credit profile that is going to be looked into. They want to see that your business credit is clean, that there are no charge-offs, there's no foreclosures or bankruptcies on the personal side. Basically, it's kind of a uniform across the board. Is this business healthy enough? Now, there's always going to be a blemish or two. A lot of these lenders can get past that. So it's not your traditional financial institution that wants an immaculate record. It's really going to be, at this point in time, are you able to support it based off of our personal credit parameters, our business credit parameters, and from a revenue and business debt service coverage standpoint.
Awesome. And so is that something that the account management team can, if you were to express to them, hey, I'm really interested in moving to these longer term products, where do I need to improve? This is something that they can point out?
Absolutely. So the first thing they're going to do is probably ask for some updated financial statements. They might look into, your updated balance sheet and P&L if you have something year to date. And if they can recognize that you're trending upwards, that would potentially determine that there is, more cash flow that's available to service a new loan. In most instances, if we are graduating you up, we're probably going to have to refinance out an existing product. So it's almost going to be a swap of the old debt, which is probably going to be higher in cost, because we wouldn't look to refinance a loan product with something inferior. So if we're able to improve your business cash flow, free up some additional working capital for you, our account management team is going to be able to look at everything holistically at that point in time as a snapshot and tell you, listen, today you can support this much. If your business is going to trend this way in the next 3 months, you can support this much. If your personal credit is, in this range, you would be able to move forward with lenders A and B. If you can get your personal credit higher and are keeping track of it, we can add lenders C and D to that. So it's really just coming up with the best action plan moving forward and seeing which lenders would be able to support you today and in the immediate future.
Great. And something I just want to clarify is, because I think the way that we've been talking about this, it's a lot about like if you need additional capital, et cetera, et cetera. But technically, if I didn't even want a new loan, I just knew that my business was doing better, or maybe my credit had a big surge because I fixed some errors in my report or something, I could still just simply refinance into a better product without needing to take on additional capital, correct?
Absolutely. And we've done that in many instances. I personally have worked with a couple clients that you, Meredith, have been able to profile where they've started in a short-term product and they've kind of worked their way up into something multi-year. And while they're in that multi-year product, taking into consideration that there's no prepayment penalty, we've actually been able to refinance them out into a SBA loan. So keep things in mind or put things in perspective. We have one applicant that was able to refinance out a $50,000+ loan with one of our short-term lenders into a multi-year loan that was a straight refi. So they basically cut their monthly cost by 70%, going from a daily payment that was, escalated on a month-to-month basis into one monthly payment. At which point, for the exact same amount, we were able to refinance them after 2 months into an SBA product for $150,000. So they essentially reduced their monthly outlier, going from a short-term loan to a medium-term loan, by 70%. And then they took that medium-term loan and were able to free up an additional $100,000, moving from $50,000 to $150,000, and their monthly payment didn't change. It virtually stayed the same because the multi-year product was termed out over 3 years and the SBA product was termed out over 10 years and came at an even lower interest rate of about 6%. And these are the nice things that we're able to kind of make happen for business owners that don't realize that they're eligible for such a structured and strong product.
Mm-hmm. Is that something you see a lot? Somebody comes to Fundera and they're just in a loan that didn't really make sense for them in the first place?
Very often. Most folks will come to us and say that, lenders were knocking on their door. They caught wind that they're a successful business. And the crazy thing with these short-term loans is they make it very easy to grant access to capital. Now, if it's the only thing that you're able to secure, sure, it might help your business and it's a good way to get moving in the right direction. But they're always going to try to renew you. And by renewing you, they make it very easy to get additional access. They see that you're repaying the loan on time. They see that you've got the availability to take on additional funding, and they want to be the ones to give it to you because it's high cost debt. So if you find yourself in a position where the short-term lenders are renewing you time and time again, that's the time to call us. That's the time to look into options that are going to be more structured, because we can almost guarantee that they will come at a lower rate. They will be more cost effective, and they will enable you to graduate again into a more structured product, which at the end of the day, we want every borrower that comes to Fundera to be able to walk into their bank and tell them what they need and get it.
It's awesome. So I'll just say that if you were watching this and you're like, I'm curious if I could to qualify for a better loan or refinance the debt that I have right now that is expensive, that's something that by calling Fundera, we can tell you yes or no, help you out there. Somebody like Mike can help you. But that being said, those are all the questions that I have, Mike. This was really, really helpful. And I hope it'll help a lot of small businesses understand how important it is to sort of see the landscape out there, see what they do qualify for, and also that they deserve to have that transparency into the benchmarks for the next step of the next best product out there. So thank you so much for joining us. And if you do want to ever speak with someone like Mike about what's going on with your business, feel free, give us a call at 1-800-FUNDERA, or you can email support@fundera.com, and we're happy to help. But that being said, that's all I have. Thank you so much, and thank you, Mike.
Thanks, Meredith.
All right. Bye, guys.